The global economy had a much better 2023 than we feared when we began last year. There were fears of steep recession or at least a global and US slowdown. The year actually ended with growth ticking much higher than expected for several large economies, especially the United States and India. In this context, how will 2024 pan out? I have with me two well-known, well-regarded economists, Jahangir Aziz, the global head of economics at JPMorgan, and Robert Sockin, the global economist at Citibank. Gentlemen, thank you very much for staying up for me, and a very happy new year to both of you. Jahangir, like I said in the intro, we spent 2023 worrying there will be a recession in the US and hence a big slowdown in the world. Now, what's your starting assumption for 2024?
We're looking at a global growth where the global economy is going to slow down. There is no question about that. You're already seeing signs of that. But the slowdown is warranted in the sense that that is part of the soft landing that we're looking for, the disinflation process that will need to happen in order for central banks, particularly in the Fed, to start cutting rates. And if that doesn't happen, then we are stuck with especially the Asian central banks. The Latin Americans have started to cut rates, the Europeans have started to cut rates, but the Asians can't do anything because they have such little margin over the Fed that unless the Fed starts cutting rate, the Asians can't do. However, if you look at the Asian economies, these economies all cannot really survive 2024 with real rates that's high. So I think for domestic reasons, they need to cut rates. But that cannot happen unless the Fed starts cutting rate, and therefore the slowdown in global economy is required because that's what's going to keep disinflation on this disinflationary trend.
Okay, got that. Jahangir, stay on. Robert, welcome and Happy New Year to you as well. Well, let me come to the more recent data. Job numbers from the US were very strong. Amid all this talk of slowdown, job numbers are strong. So what are you expecting by way of rate action from the US Fed?
This is a very key question. And even though the overall job numbers were strong in the report in terms of payrolls being expectations, I think we are starting to see a little bit of softness underneath those figures that lead us to believe that the economy is likely to slow down more later this year. Some of those being the more softness in the household employment report, particularly a drop in participation, as well as employment there. We also saw a big drop in the ISM Services Employment Index that came out recently as well. Another indicator that things might slow down going forward. So I think right now the economy has been fairly resilient, but there are signs they're going to start to worry the Fed that the economy might slow down. And what that might mean is from their communication, we're hearing that they're being fairly dovish and that they want to support the economy and want to avoid a recession. So that might mean in the background, a faster runoff of the balance sheet or sooner runoff, and maybe faster Fed cuts than we're expecting. We still have them cutting in the middle of this year, but the balance of risks are that they move sooner than that.
Okay, then Robert, what are your own growth expectations for the US? I think the average for 2023 was well over 2%, 2.1 or thereabouts. What's the average for 2024?
I think we are seeing some signs the economy is starting to slow down, but given the resilience we had last year, that forecast that actual growth you mentioned was way above expectations. You have to mark up the probability of a soft landing pretty significantly. So we're still in the recession camp. We have the economy going into recession in Q2 of this year. So we have 2 quarters of negative growth in Q2 and Q3. So that's going to lead to an annual growth rate that's pretty low given those negative quarters. But and that's a fairly mild recession by historical standards. However, I think the data are telling you that there is a higher probability of a soft landing. Data is also telling you there's a risk of recession, as I mentioned, with the labor market numbers. We're also seeing some other areas of stress, like in lower income consumers are showing some signs of strain. So it's a very difficult time for the economy And I think the next few months will really tell us whether we should move that base case to a soft landing or whether we should stick at that recession call we have mid-year.
Okay, got that. Coming back to Robert, Jahangir, India's NSO recently has forecast a sterling 7.3% GDP for the current year. Now you tell me what's your estimate for India in FY25, considering that, you are expecting rate cuts and a global slowdown.
So we are expecting the economy to slow down in the first half of the calendar year, which would mean the last quarter of the fiscal year and the first quarter of the next fiscal year. First of all, you are going to see, public investment, which has been a big driver of growth for the last 3 quarters of the fiscal year. In the fourth quarter, will have to slow down if they are to meet the budget target. We are already seeing signs of that on the monthly numbers. And I think that is one part of it. The global economy is slowing down. So services export, which has been the other crucial driver, is also going to slow down. And that we expect to continue throughout 2024 calendar year and for 2024-25 fiscal year. But you're looking at a slowdown somewhere close to about 6.5%, nothing outlandish. And again, look, these growth numbers that the NSO is producing, these are all in terms of aggregation, let's put it that way, of quarterly numbers. 2 years later, we will get the revised numbers. The quarterly numbers have serious problems with deflator issues. So I wouldn't take this very seriously, but clearly, just by looking at other indicators, from profitability to what's happening to consumption, etc., even though that hasn't been spectacular, the growth rate in India is clearly reasonably strong at this point in time.
Okay. Robert, how will you see US yields shape up? If you are expecting cuts, at the moment their yields are up again at 4%.
As we get closer to those rate cuts, right now there's a lot of uncertainty because the market's already pricing a lot more rate cuts than we have in the near term. As I mentioned, that's entirely possible, but we have fewer than that. But I think the story still is, once the Fed starts to ease, you should get those short end yields, falling quickly in coming years, and you should get that long-term yield probably falling a bit further. I kind of think somewhere in the high 3% range is reasonable for the 10-year. But again, it's going to depend on the Fed posture, and it's going to depend on the speed and extent of those rate cuts. But I think whether those rate cuts happen in March or they happen in July, I think the direction of travel is pretty clear in terms of the shape of the curve over time.
Yeah, that clearly is the consensus. Rates have peaked, no two ways about that. The problem is, when will they start getting lower? Jahangir, what rate cuts are you expecting in India from the Reserve Bank in your 6 to 6.5% assumption, GDP assumption?
So that's where the growth dynamics plays out. So we do not expect RBI to cut rates in the first half of this year. So the first rate cut will be after the Fed has started cutting rates. Our assumption is in June. So clearly it has to be in the second half of 2024, which means that the first part of 24-25 fiscal year is going to still suffer from very high real rates. It's only in the second half, with the rate cuts, you are going to get some boost, which is why growth is going to slow down in the first half of the fiscal year and then pick up in the second half of the fiscal year. That's how you get the 6.5. But we do not expect expect RBI to do on the policy rates. Now, RBI may start moving those emergency tightening measures that they had imposed in the second half of last year, when global financial conditions jumped, when the 10-year rate went to 5, dollar strengthened. I think those have all been reversed. Global financial conditions have eased. So I think that at least on the interbank rate, I think there is significant scope for the interbank rate to go back to the reverse repo rate, to the repo rate. And therefore, on the front end of the curve, there could easily be a rally, but that's largely driven by the tightening measures being reversed rather than any actual rate cut.
Okay, so not factoring too much of a rate cut, but, this morning we have even the Bloomberg index likely to include India. That could have something on the longer term. But Jahangir, the softness in India's inflation is very much dependent on the Chinese softer growth. That has helped core inflation stay in check. Now, what's your growth expectation from China? And will this deflationary impact of China on core inflation across Asia continue?
So Chinese growth, again, is a story in two parts, right? In the first part of the year, we do expect growth to be about 5.5. So the first half of calendar year 2024, that slows down to the 4.5 handle. The reason why we have the first half growth at 5.5 is the spillover of that is going to come from the fiscal support that came in 23. It came too late. It came in the month of November. So clearly it's not going to have much impact in 23. That's going to be passed on to the first half of 24. So it's a 5.5 to 4.5. We are looking at about 4.9%. We are expecting the government to basically say growth will be around 5%. So that's sort of where we're looking at. We do expect the deflation, domestic deflation, to sort of pick up, to end and then pick up, but it's not meaningful. It's like 0.9% for the year as a whole. The part that the rest of the world actually has benefited from, which is the export price deflation, we think that continues. And the reason we think it continues is because policy is still pretty much biased towards supporting industrial production, pushing up supply, investment, and not so much on demand side. So the gap between what China is going to be producing and what China will be domestically consuming will remain wide, and in fact might widen, and we expect that to keep domestic inflation low and then continue to spill over into export prices. So we do expect global goods disinflation to continue to some extent, backed by the Chinese export price deflation for at least in the first half of the year.
Oh, thank you. Thank you very much, Robert Sockin and Jahangir Aziz, for drawing up for us how 2024 might pan out. Actually, you're sounding far more optimistic than you guys sounded in 2023. A mild recession, perhaps, more chances of soft landing. But of course, incoming data will have to be watched. The first Fed rate cut put at probably June or maybe even July. And the Reserve Bank can cut only thereafter. A milder growth for India, probably 6 to 6.5%. But that's a decent number, considering, what other economies are doing. We'll wrap up on Bazaar on that note. Thank you very much for joining us. Chartbusters up next.